With me now in the studio is Capital Network's oil and gas analyst, Lionel Therond. Lionel, good afternoon, nice to see you.
Good afternoon.
We're talking Zenith Energy. Of course, for those watching and keen to see Lionel's full report, click on the eye in the top right-hand corner of the screen. So Lionel, Zenith Energy, give us a bit of an introduction if you would.
Yes, so Zenith Energy is a company which is based in Canada, incorporated in Canada, but dual listed in Toronto and London. At the current share price, the company has a market capitalization of about $10 to $11 million. The strategy is to invest in low-cost, mature onshore assets with some remaining potential, so with some redevelopment potential. And that strategy has led them to an award in Azerbaijan for a redevelopment of 3 oil fields, onshore, mature fields, which they believe still have reserves about 33 million barrels. Zenith is also involved in Italy on the monetization of gas reserves, but the reserves there are a fraction of what they are in Azerbaijan. So most of the driver for the company resides in that project in Azerbaijan.
Fine, so as you say, the main asset there in Azerbaijan, give us a bit more detail about it if you would.
So the contract area is located about 300 kilometers from Baku, the capital city, and Zenith owns about 80% of the operating joint venture with a subsidiary of SOCAR, which is the national company, which owns the other 20%. The contract is 25 years in length, so plenty of time for the redevelopment work. Having said that, they have some short-term production targets which need to be met. So this is quite important as well. The contract covers the redevelopment of 3 fields, as I've said. Those 3 fields are actually the largest field complex onshore Azerbaijan. In terms of production, just to give you an idea, those fields were started producing in the 70s, and the production peaked in 1979 at 15,000 barrels a day. But then after that, it started declining steadily, and partly through obviously natural depletion, but also because of the lack of investment, which in Azerbaijan was due to the focus on the offshore after the independence. And offshore is obviously where most of the giant fields in Azerbaijan are located. So that led to the decline of that field complex. Having said that, they are still producing. When Zenith acquired the asset, they were producing just below 300 barrels a day from 64 active wells. So obviously not a lot of production per well. And most recently, they were producing around 350 barrels a day. And the short-term goal is to achieve 1,000 barrels a day by the end of March 2018, and to raise production to 2,500 barrels a day by 2019 before some new wells are being drilled. Peak production is anticipated to reach some 14,000 barrels a day by 2033. So as you can tell, a massive upside down the line.
So you mentioned those increased production targets there, and also you touched on the development program.
Yeah.
What more do we know about this work program?
So what Zenith wants to do is to concentrate on 3 areas. The first area is to replace all the pumps inside the boreholes. So there's a program to achieve that. The second thing is they want to work over some old wells in one of the fields, which is a dormant field. So actually the production now is achieved from only 2 fields. So one is dormant. So they want to work over some of the wells. And the third one is to identify in the existing wells some zones which have not been tapped in the borehole, and perforate those zones with obviously upside potential. Zenith also intends to drill new wells, about 145 wells, right, throughout the length of the redevelopment program. And as you can tell, it's a comprehensive program, and the cost is going to be about 750 million. So quite a high price tag, but as I said, massive potential down the line. So there are a couple of obviously it's only the start of the project, but there are a couple of indication that show that the management is tackling the work in the right way. The first one is their strategy to own their own assets and their own resources, which I think is quite smart, because obviously you keep control of the operational oversight, and you can minimize cost. And the second one is the financing strategy, which mixes debt like vendor financing to minimize the rise of equity, and obviously minimize the equity dilution, which is I think very important for shareholders. So far, the work which they have done on a few wells have led to very positive results. They managed to raise production by 40 to 70 barrels a day for each well, compared to expectation of 10 to 15. So I think it started well so far.
Started well, plenty happening. What does all this mean in terms of valuation, Lionel?
Well, our valuation is about 41p per share. And we derived that from essentially two methods. One is a DCF, and another one is just peer group comparison. And the average of the two give us that's 41p per share. We also take into account the potential for dilution. Looking at the cash flow projections, we have identified an equity gap of financing gap of about $35 million, which we address by raising equity in our valuation, raising equity at the current share price. So obviously that implies some dilution, and we get to 41p that way. Now obviously it's a substantial upside compared to the current share price, and there are some very substantial risk attached to that also.
Well, tell me a bit more of those. What are some of the risks associated with that valuation, Lionel?
So for these kind of companies in startup stage and financing requirements which are quite heavy, obviously dilution risk is the main risk, raising additional financing. Some of the risks are not in the management control. Obviously, oil price is not in management control. If the oil price environment was to be much weaker than we anticipate in that valuation for the rest of the project, the length of the project, obviously that would raise the financing risk and or financing requirements, and obviously that would increase dilution. Another risk is for the company to find the current fields or the current wells in worse conditions, so they would have to spend more money or not be able to raise production as much. So obviously that would detract from the plan and require more financing or more time, which would obviously create a lot of volatility in the share price. But beyond that, those risks which are not in management control, so far we believe that from what is in their control, they have done quite a good job. And don't forget that management owns about 20% of the company, so obviously they are very focused on its success.
Lionel, thanks very much for your analysis. Good to see you.
Thank you very much.
And a reminder for Lionel's full report, be sure to click on the eye in the top right-hand corner of your screen.